Are you ready to take control of your wealth and design the life you envision for yourself and your family? Welcome to Wealth of Insight with Austyn Whittenburg from Whittenburg Wealth Partners. Austyn guides you through the entire planning process to help you build a plan that seeks to protect your financial future. He empowers you with creative investment opportunities and planning ideas to help you understand and achieve your long-term goals. It's time to gain confidence in your financial future. Now, on to the show.
All right, welcome back to the Wealth of Insight podcast. I'm your host, Austyn Whittenburg, and today I'm joined by Troy Heidenreich from CrossCountry Mortgage. We're going to talk a little bit about credit today. Thanks for joining us, TJ.
Yeah, thanks for having me, Austyn. I'm excited. This will be fun.
Before we get too deep into credit and what it is and why we need it, I thought I'd give you 30, 60 seconds just to give us a little bit of your background and how you ended up at CrossCountry Mortgage.
Yeah, so I'm a mortgage lender. I've been in the lending industry since 2017. I actually got into the mortgage industry from my cousin Brock, who I think has been on the podcast before.
Yep. Yeah, he has.
So I saw him running the mortgage game, and I thought it looked fun, so I got into it, and we haven't looked back. But a little bit about our team. We consider ourselves holistic mortgage planners as opposed to drive-through mortgage. We take a deeper understanding of what our clients want, both short and long term, and try to customize and curate their loan package for them to achieve their goals in both financially and in the real estate game.
Yeah, no, I appreciate that. That's why we like working with Brock and your team as well. That sort of, it's not just about necessarily the lowest rate or whatever. There's lots of factors that go into making sure the mortgage and things are a good fit. So, okay, perfect. Well, let's hop into it now. As I mentioned sort of in the intro, we're going to talk about credit today. Yeah. So the first question I have for you is, what is credit?
Yeah, for sure. Credit is this weird, kind of gray area. They don't teach you about it in school, which they should.
It's totally a secret, right? Totally a secret.
Right. It's one of the most important things. And in fact, I think what I learned in credit or about credit in school was bad. I think I took like a Dave Ramsey course in high school. And everything he said, just stay away from it. There's alternative forms of credit to buy a house and all of this stuff. And later I'm like, okay, I actually need this in order to succeed in life. So basically, credit is, in a nutshell, the bank trusting you that when they're lending you money or whatever they're lending to you, that you're going to pay them back in a time, in a certain time that is put on that contract. And that's how they build that trust over a certain period of time. And based off of your past experiences with borrowing, how likely they are to get their money back in the written time in the contract.
Yeah. So and most people, I think about it. Well, and a credit card, I guess, is the easiest, most common example that everybody knows with. The credit card company, American Express, lends you money to go buy something. We don't have to give American Express money till at some point in the future, right?
Right, exactly.
To pay that back. But there's so many more applications really throughout your life.
Right.
But it is, we sort of joke, it's this secret thing. It's like, you got to have it, but you can't get it if you don't already have it. So how do we, what are some basic tips getting started to building credit? And how do we make sure that clients are building this resume so that a bank will lend them some money in the future? Right.
And it really starts off because the number one factor of credit is time. So you want to make sure you've got a good amount of credit under your belt for a long period of time. For myself, a lot of my clients that are younger, that say they're young, early 20s or they're 18 even, they don't have a credit score. I'm like, okay, go to your credit union and get a secured line of credit or a secured credit card. And that's almost acts as if it's like a gift card where you're prepaying money onto a card and then using that card. And it's actually reporting to the credit bureaus and you can build credit fast. It'll take about 3 months. And as soon as you start doing that, you'll start to see a score accumulate.
Interesting. I actually have never even heard of a secured credit card like that. I know, and I think this is actually really important that we're starting with younger people here. One of the things that my parents did for me, whether or not this was the right way or not, is basically they said, hey, go get a credit card when you're 16 so you can put gas on it. Yep. And we'll just, let's just, if there's $250 a month or whatever it is you're buying in gas, just to pay that off. And if for whatever reason you can't, hey, maybe we'll just help you do that, right? Just to make sure that you don't, because you can really screw up your credit if you early on too, right? If without that history,
for sure. Especially if you don't have the history, you're going to see
one little
go out faster.
One miss, one late payment or whatever. If it's you're 2 months into building credit and you already miss a payment, you're in trouble.
Right.
But that secured credit card, that's not even something I've ever even heard of.
It's a quick hack to build credit fast. Another hack that I've seen too, if you're newer to credit, is get added on as an authorized user to someone else's credit card. So if your parents are, or if you have someone in your life that is religious about making on-time payments, you trust them, and they have a good credit history, they can add you on as an authorized user to that credit card, and you'll adopt a little bit of that credit history on that credit card. So that'll also help build credit quicker. Yeah.
So parents out there, if you're listening, these are some ways to get your kids a head start here, because as you're looking and growing in life, you want to get a car or a house or any of these things, you got to have credit. And if you just show up at 25 ready to buy a house, but you've never had credit before, getting a mortgage or something like that's going to be,
there's going to be a lot more hoops you have to jump through. Ultimately, it's going to be more expensive for you in the long run if you don't have credit.
Yeah. I'm glad you mentioned that. So let's hop into that too, because there's all these ranges of scores, right?
Yeah.
And some of them are considered good. Some of them are bad. Some of them are really good, right? Can you walk us through sort of what are the ranges? What makes, where obviously people want to have the highest score, but that's also this, to be the highest score isn't necessarily, even people with perfect credit histories may not necessarily have the highest score. So sorry, I'm rambling on a little bit here. Can you just walk us through sort of the ranges and what's considered good, what's considered bad, and how that sort of breaks down?
So on our team, we see well over 500 applications per year. So we see the whole spectrum. We see no credit all the way up to perfect credit. And it's important to realize that when you pull your score on like Credit Karma, or when you pull your score from like an auto loan, or when you pull your score when you are doing a mortgage application, they're all going to be different scores. There's another like secret thing. Nobody knows what your actual score is, right? Yeah, nobody ever tells you that. So there's over 55 different algorithms of pulling your credit, and they're all different. So when I pull it for a mortgage application, my client could check just the day before, and it could be a different score. Now it's not going to be off drastically, but it might have a 5, 10, 20 point difference. So that's important to recognize. But I mean, I'd see a poor score, that's going to be your score below 600, I would say, or 620. Now I've seen scores in the 400s. Sure. That's just when we've had irresponsible people opening credit cards and never, ever making a payment, or auto loans. Then your fair credit, that's going to be your 620 to, I'd say, 680. This is going to be a score where maybe you have young credit, so you don't have that much reporting to your credit, or maybe you've missed a payment or two on a credit card throughout a couple year span. And then your good credit, that is going to be 680 to, I'd say, the 740, 760 range. This is you're pretty good on actually could be excellent, about paying your bills, but maybe you have a younger credit history, or maybe you have one late payment somewhere.
Can you define younger? Sorry to cut you off here. Yeah, define younger credit history. So I'm 34.
Yeah.
I've had credit now probably 15 years or longer. But I swear, even when I pull up like a Credit Karma or something, it still says, your history isn't long enough, which seems, and maybe I'm misreading it, I don't know, but it seems like I've been at this for a while.
Right.
Like what are they looking for in terms of historical length of credit? Yeah. So I would say and on the mortgage game, I would say that anything under 4 years is probably going to be on the shorter end of a credit history. So where you're probably not going to have as good of a credit score. Now I'd say 4 years and above, maybe even 5 years, that's where you're going to get you're going to see your bump from, if you have perfect credit, from your 720, 730 range up above that 760 range. Does that make sense? Yeah. So, and what is sorry, I'm getting us off topic. Well, not off topic, but just sidetracking here a little bit. What is like the top score? What's the best score you can have?
So anything above 760 in my eyes is perfect credit. So
Okay.
a lot of people like to brag like, oh, I'm above 800, but in the lender's eyes, and it's all the same when it's
It's
above
not
7.
that much of a difference. Okay.
Yeah, exactly.
Okay. So there's the ranges of scores.
Yep.
Now, how do you build, or what are the factors in that calculation? You mentioned all these different algorithms. I know, right? So you got things like how long you've had credit, right? So your credit history, just does the overall outstanding, I guess, amount of credit, is that something that factors into the calculation?
We call it the credit wheel. So 35% of our credit score is going to be our payment history. So that's the biggest chunk of the wheel. So we want to make sure we're making payments on time. If you want to help your credit the most, it's just pay your bills on time, and your credit over time will be greatly affected by that. Second is utilization. So that means, say I go to the bank and I get a credit card with a limit of $1,000 on it. I don't want to use more than 50% of that $1,000. If I'm using more than that, if I have a balance of greater than that $500, then that means, that I'm going to get a worsened score for that month, because it's going to show that my utilization is high. The money range is going to be 10 to 30%. I'd say about 10% utilization. That's where you're going to see the best score. Now, it can also work in the opposite direction for you. Say if you don't ever have a balance on that, it could actually hurt you because you're not using your credit.
Yeah, that's something I hear about all the time. And it seems like I've heard conflicting views on that. But some people say, well, you should pay your credit cards off every month. Some people say, well, you should leave a little bit of a recurring balance on there, because then it shows that it's getting used, a little bit. It's not just sitting there totally dormant.
Yeah.
So, and maybe we can save that for a minute, but there's all these myths out there I want to make sure we address too, because that's one of the things I hear all the time is, should I pay it off or should I leave it because I need it to ding so that the credit reporting agencies realize that I'm actually using it?
Right. Yeah. I'll dive into that a little bit right now. If you've got hold on, we'll dive back into that when we go into the myths and whatnot, because another big one is the length of credit, which that's 15% in the wheel. So the credit history, like we talked about. The next one is new inquiries. So if you're applying for new credit, that's about 10%. We want to make sure that we're not applying for credit all the time. We want to keep our inquiries, I would say, less than 6 in a 2-year span. Now, if you're going to go like 8 to 10 in 2 years, it's not going to kill your credit, because again, it's only taking up for about 10% of this credit mix of the credit wheel. But if that's just like, don't get your credit pulled 20 times. That's when it's going to start to really affect your credit.
Okay.
And then the last part is your credit mix. So you don't want to have a bunch of the same type of debt, meaning you don't want to have only credit cards, which is revolving debt. So there's revolving debt, installment debt, and then mortgage debt. So your installment debt, that's going to be like your auto loans or a trailer loan or boat loan. Your revolving debt, that's going to be like your credit cards. And then your mortgage debt is going to be, of course, your mortgage. So having all three is going to show that you're diversified in all of your credit, and that's also going to help your credit. So when I go back to that myth of paying off your credit card every month, it's not really going to affect you all that much if you've got a broad credit scheme. But if you've got all three types of credit behind you.
Okay.
But if you only have credit cards, if you've got like a 0% interest card, it's like an introductory rate or something like that. Right. I would suggest actually having a tiny balance on that you're just paying the minimum every month. That is really it's gonna help your score quick.
Start building that up. Yeah. Interesting. That's, I'm obviously, as a financial advisor, I'm definitely opposed to credit card debt. It seems to be the worst kind, the highest rates, the worst, but there are these tricks, right? Again, if building credit.
Yes.
So let's talk real quick then, and maybe we can just use mortgage language for this, but I think it applies in different areas. But what's the point of having a good score versus a fair score? Like why does that really matter?
Yeah. So if you've got like over 760 credit, or if you're below 680, that's going to factor into a couple of different things for you. Number one is going to be your interest rate. your interest rate on your mortgage is going to have a pricing hit of sometimes up to, it depends on the loan program, but sometimes up to 0.5% in rate, which is, you could legit be throwing hundreds of dollars out the window every month.
Yeah, that makes a big difference for sure.
Yep. And then if you own less than 20% of your house, you're subject to mortgage insurance. And mortgage insurance also looks at your credit score. So if you have a poor credit score, you're getting hurt on the rate and you're paying more in mortgage insurance, which ultimately isn't going to anything. It's going to protect the bank as opposed to protecting the borrower.
Right.
So then you're paying another $10 to $50 a month in mortgage insurance just because you have a worse credit score. I'd say that's the biggest factor with having not as good credit.
Okay. So if you've got you mentioned you see scores in the 400s, right? There's a lot of things. And I've seen that too. Clients, maybe there's been a divorce, or if could be any number of reasons why things get that bad. But if, what are some things that a person can do? Maybe they're in that, let's call it 650 range, right? They're on the verge. They're really close to being able to get up into a better range. Mm-hmm. What are some things you can do to fix or to improve your credit situation?
Yeah. So if they're specifically looking for a mortgage, I would say talk to us and we can run through a loan application with us, because I can run some scenarios. We work directly with the bureaus in a sense that I can run like simulators to say, okay, if we were to pay off this credit card or pay down this credit card by X amount, it's going to put us in this utilization range and your experience score will go up by X amount. So we can get really specific with it. But first, in a more broad scheme of things, if we're just trying to generally work on our credit, I would say look at our utilization to see if we can put our balances below that 50% threshold first. And number two, if we have any accounts that are derogatory or that we've got collections on, let's get those removed. Now, let's not only get those removed though, try to negotiate with the collection company to say, hey, if I get this off my credit, will you delete this? Or if I pay you off, if I pay this debt off, will you give me a letter? It's called a deletion letter. And that way I can get this off my credit. That is going to improve your credit I've seen it improve by over 100 points by getting a deletion letter.
So that's the perfect jump in then, I think, to sort of the myths or misnomers or how people screw things up is you got a collection and you just think, oh, if I've got a collection on my report, I just need to pay it off and then I'm good.
Don't just pay it off.
But that's not true, right?
Yeah. And reason being is because I paid off I'm paying off my debts. It's going to be better for me. Well, it's not, because the way that the banks are looking at it is if they see your credit report and you've got a collection from a couple of years ago and you didn't touch it and now you paid it off. Well, now that collection is now going to report back to the agency or back to the credit bureaus. And it's going to update the date at which it was last paid. And it's going to look as if you just had an updated collection that you paid off. And it's going to actually affect your credit negatively.
Interesting. So it sort of pulls it forward almost.
Exactly. You're pulling dated information forward, which is going to look worse on your credit. And actually could negatively affect your score.
Okay. So I think that's a good tip for people out there. If there's a ding on your credit, paying it off is not necessarily just, that's not the only thing you need to do. There's that deletion letter thing that you mentioned. What are some other misnomers or myths out there about credit that people, how they get themselves in trouble? Yeah,
I would say in the mortgage world is, hey, I heard that if you pull my score, it's going to hurt it. And I don't want to hurt my score. I want to actually start looking at houses before you pull my credit.
Yeah. Well, you just mentioned, right, part of your pie was how many times it gets drawn, right? So again, something you hear all the time. And is there a difference between soft and hard? And does it matter?
Exactly.
So, let's spend some time on that.
Exactly. So like I said, we're pulling over 500 applications a year, and not one single time have I seen the credit be negatively affected from our single pull. Now, say I've heard, if you've bought a car and they say, hey, do you want to shop for the best rate? Well, what happens there is they send your application off to tons and tons of credit unions or wherever they're getting auto loans from, and they're all pulling your credit. Well, if you're getting your credit pulled 10 times a day, that's where it's going to really hurt. But with a mortgage inquiry, a single inquiry, it's not going to affect your credit. In fact, it might even be better than what you thought it was, because it's, again, that different algorithm that we're pulling it from what you're probably seeing on Credit Karma. So I don't think that's going to be a huge factor. In fact, it could be worse for you, because if we do a soft pull, yes, we could do a soft pull, but we don't see everything on your credit mix. And say you find a house and you're going to contract, you put earnest money down, which, if we're past a certain date, that earnest money could be lost if we have to cancel, and it could go to the sellers. So if we're not doing our homework up front and really digging deep into credit, you could be out thousands of dollars.
While we're on this topic, Credit Karma, or I think a lot of credit cards even now, I think I have the Costco credit card, and they give me my report.
Yeah.
How is that what you're talking about here as well? Or using something like, if I pull up my Credit Karma account every day and look at it, that's not a pull, right?
That's not a pull. Yeah. It's not going to hurt your score. No, that's almost as if it's like a soft pull.
Okay.
Yeah.
Okay. So then the other thing I hear about from a sort of a misnomer, and I think it's similar to paying off a collection. I've had clients where they pay off, say they're trying to get a mortgage, trying to qualify. Yeah. And I got only $5,000 left on my car loan. If I just knock out my car loan, then that frees up all this cash flow.
Right.
But similar to just, I guess, knocking off a collection, paying off a line like that.
Yes. That
may negatively impact your score, right?
Yeah. So you nailed it. So if I've got clients that are only a couple of months left on their auto loan, they're like, oh, well, let me just pay this off really quick before you pull. That could actually negatively affect your score. Now, not for a long term, but you could see your score negatively affected by about 10 to 50 points for about 3 or 4 months. So which could be huge. That could pull you in from one bracket range to another bracket.
Yeah, if you're right on the edge there.
Right. So in that case, it might just be worth not paying it off as long as there's no qualification issues or anything there. Yeah.
Okay. Great. So that was the biggest thing, biggest misnomer I think I hear. So is there any other, as we wrap this up here, any other issues or misnomers or myths about credit you think people need to understand better?
Yeah. And the last thing I would say is, if you're looking to buy anything or make any financial moves, don't add any accounts before talking to someone. Because if you're pre-approved for a house and then you say you get excited and you're under contract on a house and you go to RC Willey and open up an account for furniture,
got to get your furniture.
That house, it could negatively affect your score and it could push you out of qualifications. So make sure you're talking to somebody about that before you're doing so.
Okay. Lastly, now that just popped into my head, but we've mentioned Credit Karma a few times, or just, monitoring your credit score. Yeah. That's another thing. I think, I'm sure you see it every day, and we see it all the time too. The amount of people who've had some sort of identity theft or stolen credit, right? So using something, like whatever sort of credit monitoring service you use, I think is really important, because that's another surprise you don't want to see when you show up to get credit when you need it. And then, oh, hey, 3 years ago, you opened a cell phone at this place, which you didn't. And then something like that just can become such a nightmare.
Yes, for sure. And you can call the bureau. Say if you're not going to be touching your credit for a long period of time, you can call the credit bureaus and freeze your credit. That way, no one can touch it. You're going to be safe from any form of identity theft. So if you're not going to be touching credit for a long time, I would suggest doing so.
All right. I think that's a great tip there to end on, for sure. So, again, TJ, thanks for joining us today. Where can people follow you, find you? I'm presuming you've got a LinkedIn and that kind of stuff. You can follow
our team on all platforms at Loans Elevated. If you have questions, feel free to give me a call at 801-694-1733.
Perfect. And if you have any questions for me, you'd like to learn more, please check out our website, wittenbergwealth.com, or you can text me at 801-839-7056. And please remember to subscribe to The Wealth of Insight and tell your friends and family. Thanks.
Thank you for listening to the Wealth of Insight podcast. Click the subscribe button below to be notified when new episodes become available. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Whittenburg Wealth Partners are separate entities from LPL Financial. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Whittenburg Wealth Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.